Mientras los índices bursátiles alrededor del mundo colapsaban durante el gran encierro creado por la pandemia, el año 2020 vio niveles récord en el volumen de derivados negociados alrededor del mundo. En medio de la crisis, estos demostraron ser la herramienta idónea para mitigar riesgos. Es un honor presentar la conferencia magistral Current Structure and Trend in Derivatives Markets. John Hu, la autoridad reconocida internacionalmente en derivados y gestión de riesgos y con múltiples libros y publicaciones al respecto, y además es profesor en la Joseph L. Rodman School of Management de la Universidad de Toronto. We welcome John to the Risk Management and Trading Conference 2021.
Hello. It's a pleasure to be here. It's hard to believe, actually, this is the 10th year of this conference. I've been involved every single year for the last 10 years, and it's been a great conference. The title that Riskmathics gave me for this presentation, Current Structure and Trends in Derivatives Markets, gives me quite a bit of flexibility as to what I'll talk about. And it didn't take me long to decide that the Libor transition was the big, shall we say, the big event as far as trends in derivatives markets are concerned. When you think about it, in the over-the-counter market, 70% of the transactions, roughly speaking, are interest rate swaps, and most of those depend on Libor. And then in the exchange traded market, of course, the euro-dollar contract is by far and away the most popular contract, and that has a payoff dependent on Libor. So the discontinuation of Libor is going to have a huge effect on derivative markets, and that's what I want to talk about today. In fact, I came, the impact of the transition away from Libor had a big effect when I was writing the 11th edition of my book, Options, Futures, and Other Derivatives. It was a project I had last year, and pretty much every chapter of the book talked about Libor in one guise or another, and that created a huge number of changes and made me realize just how central Libor is to to derivatives markets. So first of all, let's I'm sure most people are familiar with the background of the phase out of Libor, but let's just talk about it a little bit. So first of all, how's Libor determined? Libor is determined by the Intercontinental Exchange for different currencies and maturities, as we'll see in a minute, 5 different currencies, 7 different maturities, from estimates provided by usually 18 banks on the rate they would pay on borrowings from other banks. Now, the critical thing here is the rate they would pay. It doesn't mean they're actually borrowing any money from other banks. They're just estimating the rate that they would pay if they did borrow from other banks, which is, an important difference. So ICE gets these 18 estimates for all these different rates, 5 different currencies, 7 different maturities from 18 banks. It lops off the top 4 and the bottom 4 so that it's left with the 10 in the middle and averages those. So it's something like, an interquartile range that it uses, not quite an interquartile range, but close. And Libor rates are used as reference rates, as we all know, for literally hundreds of trillions of dollars of transactions. Lots of derivative transactions, as I've just mentioned, but also, mortgages and other sorts of loans throughout the world. US Libor is particularly heavily used, and we'll get on to talk about that in a minute. But the key thing is that for the most part, Libor estimates are not based on actual transactions. They're based on estimates of what could happen. So what are the currencies and the rates? The currencies, 5 currencies: US dollar, British pound, the euro, Japanese yen, and Swiss franc. those are, the main currencies, but of course, many other currencies have rates which are similar to Libor, as we'll see. And then the borrowing rates, 7 different borrowing rates: overnight, 1 week, 1 month, 2 months, 3 months, 6 months, and 12 months. So that's 5 times 7, 35 different interest rates that have to be provided by these 18 banks every single day. And it's the rate at which they could borrow just about 11 o'clock in the morning London time. And the question is, what is the rate they could borrow in London markets at that time? So why is Libor being phased out? Since 2012, it's become clear that there's some manipulation going on in Libor, because it's just an estimate. People can, make high estimates or low estimates depending on, what they're trying to achieve. And, of course, if just one bank, for example, gives a really low estimate for Libor, that may not have too much effect, because remember, the top 4 and the bottom 4 estimates are not used. But if banks collude, so say, well, I'd really like to have a low estimate for Libor today, maybe call friends at another bank and say, yeah, could you give a low estimate for Libor as well? And then when you need help about a low estimate or a high estimate, I'll help you. So those estimates, not only was there manipulation, but there was also collusion. And there's been many lawsuits about this, lots of fines, and some employees have actually served time in prison as a result of Libor manipulation. So let me just add a couple of things to this. It's kind of interesting that, even before 2012, there was a sort of feeling that Libor was being manipulated. In 2008, a former member of the Bank of England Monetary Policy Committee described Libor in a speech as the rate at which banks do not lend to each other, which was sort of indicating the nature of the problem. But even more striking than that was that in 2012, the Financial Times had an article in which it quoted a former trader as saying that Libor had been manipulated since at least 1991. So this former trader, so that, what we're saying is that if that former trader is correct, Libor had been manipulated for around 30 years. Libor's sort of only been around for about 40 years. So, that's a rather damning indictment of the financial markets. So once this became evident, then it was clear that it was necessary to replace Libor, and the regulators stepped in. And here are the replacement rates that they would like to use. And so in the United States, SOFR is the rate. It's a repo rate. So it's about transactions between banks that are secured transactions, because they're basically situations where you lend securities and agree to buy them back at a slightly higher rate later. So secured overnight funding rate. British pound Sonia, Euro Ester, Japanese yen Tona, and Swiss franc Seron. So the SOFR and Seron are repo rates. The other 3 are unsecured rates, but they're all based on overnight borrowing and lending, because that's a pretty liquid market. And so, we can base the replacement rates on actual transactions rather than estimates. And that's, of course, what regulators want to do. In Canada and Mexico, we're not part of the, the 5 big currencies, but something similar is happening. In Canada, we're moving away from LIBOR-like rates to something called CORRA, which is a repo rate, again, an overnight rate. And in Mexico, moving to an overnight TA rate, which is also a repo rate. So there's a trend in other countries besides these away from term rates, which are relatively illiquid, to overnight rates, which are much more liquid. One of the things that regulators look at, or not just regulators, but the market generally looks at, is the ratio of how many transactions depend on a particular rate or set of rates, and how many transactions are used to determine those rates. So as I said earlier, hundreds of trillions of dollars of transactions depend on LIBOR, say 200 trillion, 300 trillion, something like that. And it's estimated that actually only about 1 billion of real transactions actually determine the rates. So the number of transactions determining the rates, as I say, about 1 billion. The rest is just, as it were, estimates. And but 200 trillion of transactions depend on the rates. So that worries regulators when, the market for the transactions that are determining the rates is relatively illiquid. Now, as far as overnight rates are concerned, that 1 billion of transactions goes up to about 900 billion, nearly a trillion. So in terms of the transactions that are happening every single day. So it's, we're talking about a much more liquid market, a market that's, very much more difficult to manipulate. And that, of course, is what the regulators are looking for. So the plan, quotes will no longer be made for the British pound, the euro, the Japanese yen, and the Swiss franc after December the 31st, 2021. So 4 of the 5 currencies will no longer have LIBOR quotes after the end of this year. And in fact, there's signs that there's less transactions based on, those LIBOR rates actually being made now. Now, as far as the US dollar is concerned, US dollar is a bigger problem because US dollar LIBOR is used to a much greater extent than the other 4, and quotes will no longer be made for 1 week and 2 month US dollar LIBOR after the end of this year. Why those 2? Well, those 2 are not used as much as the other ones. So basically, we can no longer make quotes for 1 week and 2 month LIBOR after the end of this year, and of course, those are highly illiquid markets anyway. But the other 5 maturities will continue to have quotes after the end of this year, and that'll continue until the middle of 2023. So, basically, we're talking about an extra 18 months of quotes for US dollar LIBOR for the 5 major maturities. But the regulators have said they don't want to see any new US dollar LIBOR transactions after the end of this year. So in other words, the quotes, the idea anyway, is that the quotes will be for the existing transactions. And there'll be no new transactions. So we'll see how that works. It's very difficult to stop banks agreeing to transactions that depend on LIBOR. But we'll talk a bit more about this in a minute. But that's the regulators are being quite definite about the fact that they just want to see a discontinuation of transactions dependent on LIBOR starting now, but basically as far as the US is concerned, no new ones after the end of this year. So what's the key difference between the old reference rates, the Libor rates, and the new reference rates that that regulators would like to bring in? And one of the key differences is when the rate is known. So if I lend you money which is based on 3-month Libor, we know 3-month Libor. There may be this manipulation and so on, but we know what 3-month Libor is at the beginning of the period, because it's this average of the 10 middling estimates from banks on whatever day it is that's the beginning of the 3-month period, because of course Libor estimates are made every day. Now, what about a 3-month rate that's linked to, say, SOFR or one of the other overnight rates? That's not known until the end of the 3-month period, because what we say as far as that's concerned is that there's the first day of the 3-month period, you earn whatever the overnight rate is for that day, and then it's compounded for the next day, and then compounded for the next day, and so on throughout the 3-month period. But of course, you don't know what all the rates have been during the 3-month period until the end of the 3-month period. So this is kind of like me saying to you, okay, I'll lend you money for 3 months, but I won't be able to tell you what the rate is until the end of the 3 months, because it depends on, how these overnight rates move. And, that sounds fishy. And it'll, at the very least, it's going to take the market quite a bit of getting used to the fact that floating rates are not known at the beginning of the relevant period, they're known at the end of the relevant period. So how does this compounding work? So this is my only equation, I think, in the slides, but let me see. We've got a series of days. Let's suppose we're talking about 3 months. We've got a series of days during the 3-month period. Today is Wednesday, so if Wednesday is the first day of the 3-month period, that would be R1, the overnight rate for the 3-month period, and that would be applied to a 1-day period, because D1, we're going to get a new overnight rate tomorrow, so D1 would be 1 day. That would be 1 divided by 360. Okay, so you'd take the rate and apply it to 1 day, and so you'd multiply the annualized rate by 1 divided by 360, and that would give you the compounded amount you get after the first day. And then we get to tomorrow, Thursday, and we get a new rate, and again that applies to 1 day, and so we multiply the compounded amount by the new overnight rate multiplied by 1 over 360. And then the Friday rate will apply to 3 days over the weekend. So that's going to be multiplied by 3 divided by 360 and so on. And, so it's a compounded rate, compounded day by day over the life of over the period that we're talking about. And as I say, the big thing that everybody has to get used to as far as the new reference rates are concerned is that they won't be actually known until the end of the period that we're talking about. And what's another key difference? Well, another key difference is that Libor incorporates some credit risk, whereas the new rates don't. The new rates are generally considered to be risk-free. If I'm one bank and I lend money to another bank for 1 day, that's pretty risk-free, because I wouldn't be lending the money to the bank if there was any small chance of a default in 1 day. And so the new rates are essentially risk-free. They're called RFRs, risk-free rates. And, this is one of the interesting things that, in theoretical world of derivatives, we talk about risk-free rates this, risk-free rates that. We've now actually got rates which everybody else calls risk-free rates as well. So we're actually talking the same language now. So what's the difference between, shall we say, US dollar Libor and SOFR when it's compounded forward for the corresponding period, say 3 months? It's about, there's not a huge difference. It's about 10 basis points. But US dollar Libor, because it's a term rate, does actually incorporate some credit risk. There is some chance, there may be virtually no chance that a bank will default in one day, but if I lend money to another bank for 3 months, there is some credit risk. And that credit spread, which I say on average is about 10 basis points for 3 months, it moves up and down. And during the 2008 financial crisis, it actually reached 364 basis points at one stage, which is pretty incredible. But credit spreads in the market move up and down, and so might say it's very nice to have a risk-free rate as a benchmark, but very often, banks want to use a reference rate that actually incorporates credit risk, so that if a bank is lending money at a floating rate, it would like that floating rate to reflect the latest information on credit spreads, which the new reference rates won't. So we have all these trillions of dollars of transactions that depend on Libor, and some of them are derivatives transactions, some of them are regular loans, and so on. They don't all end, some of them extend beyond the period of time when Libor will will be discontinued. It will no longer be quoted. So the question is, sometimes we have 10-year, 20-year, 30-year interest rate swaps. So you can imagine any bank is going to have on its books transactions which go well beyond, shall we say, the middle of 2023, which is when US dollar Libor will be discontinued, and many loans extend beyond the period when rates will be discontinued. So what happens? Well, it may well be that the two parties that have entered into a transaction that's dependent on Libor, it could be that they will modify their contract, and that's what's recommended, that people get together and modify their contracts and agree on how the contract should be changed in the event that Libor quotes are no longer made. Okay, because most contracts that say you will pay Libor plus 80 basis points or whatever, they don't include language saying what will happen if Libor is no longer quoted. So you have to add something to the contract saying that. But let's suppose that you just don't do anything. Then ISDA has come up with a fallback protocol. And basically the way this works is that we replace Libor by the corresponding RFR, that's the corresponding overnight rate compounded for the period in question. So if it's 3-month Libor that the contract depends on, then it's going to be the overnight rate compounded for 3 months. So you replace Libor by the overnight rate compounded for 3 months and add a spread. And the spread is going to be the median of the spread observed during the 5 months prior to discontinuation of the rate. So, if we're talking about, GBP Libor, which will be discontinued on December the 31st, 2021, discontinued at the end of this year. My understanding is that what's going to happen is that they will look back and I suppose it depends on the 3-month GBP Libor. The Fallback Protocol will look back at the 5 years preceding the end of 2021, which I guess will be 2016 to 2021, and work out what were the Libor quotes, what were the 3-month Libor quotes during that period, and what were the corresponding compounded overnight rates, and then take the median of the spread between the two, and that's that's what will apply. So basically, if you do nothing, then probably the Fallback Protocol is what will apply to you. Now, the market likes forward-looking rates, and it likes rates that incorporate credit risk. So the market is not that keen on the new overnight reference rates that have been proposed by the regulators. And there's a search going on. You can read articles in Risk Magazine, for example, about who's winning the search at the moment in terms of a new forward-looking rate. So what the market would like to find is a forward-looking rate that incorporates credit risk. And there's 4 or 5 possibilities, but the two main ones that I've listed here are BSBY, the Bloomberg Short-Term Yield Index, which is the average yield at which large banks access unsecured funds. So this is based on actual transactions, but there's a certain, but they do a certain amount of curve fitting and that sort of thing. So the actual transactions might be, say, a 9-month transaction. You might be able to observe one 9-month transaction, one 3-month transaction, and so on. And they'll fit a curve through those and come up with what they think are overnight rates, 1-month rate, 3-month rate, 6-month rate, and 1-year rates. So these, BSBY is based on actual transactions, but there's a certain amount of curve fitting and that sort of thing that goes on in determining the rates. And that's a rate that you can observe. They've been quoting that for a while. And Maribor is another one created by the American Financial Exchange, and that reflects actual borrowing costs, but it's the borrowing costs of thousands of community and regional banks in the US. And it produces overnight 30-day, 90-day unsecured rates, as well as a couple of other rates. So, there's you could say there's quite a competition going on right now in terms of coming up with a rate that's, shall we say, a Libor-like rate. It's forward-looking. You know what the rate is at the beginning of the period, and it reflects credit risk. And now the regulators are a little wary of this. They don't want to, find themselves in the same situations they found themselves in with Libor, that you have hundreds of trillions of dollars of transactions dependent on, say, a Maribor or BSBY, and then those rates become pretty illiquid. And so, and the problem is, if there isn't one rate, if there's several rates, then you could have a number of different illiquid rates and people entering into contracts to sort of hedge one rate against another rate and that sort of thing. I don't know whether it's better that just one rate wins the competition, or that there's many different rates that people come up with or that are used in contracts. So, one of the problems I had actually in moving my options, futures, and other derivatives book into the 11th edition, which I mentioned earlier, was that this is an evolving situation. It'd be nice to say, well, we've moved away from Libor and this is what's going to happen. but it is, not as clear cut as that. It's not clear how things will evolve as LIBOR is phased out. Now, one thing I did preparing for this presentation was look up some statistics on exchange traded rates, and now the CME group has this very successful Eurodollar futures contract, and it's not only Eurodollar futures but Eurodollar futures options contracts. And if you look at the top 5 contracts in terms of open interest that trade on the CME group, they're all Eurodollar contracts, either Eurodollar options or Eurodollar futures contracts. And the top 2 are shown in these tables. So, for example, the open interest on June the 14th for Eurodollar futures was about 13 million contracts. And for Eurodollar futures options, it was even more. It was about 15 million contracts. Now, the interesting thing is that this is a contract that pays off according to what LIBOR is at a particular time in the future. So the market doesn't seem to be too worried that LIBOR is being phased out. The market is continuing to trade Eurodollar futures and Eurodollar futures options very actively, and there's actually 3 more contracts which are the next 3 in the pecking order as far as open interest is concerned that are also traded very actively. So I guess the moral for the CME group here is that when you've got a really successful contract, it's very difficult to wean people away from the contract. What the CME group has done is come up with, of course, once SOFR was established as the new reference rate, they introduced a contract that depended on 3-month SOFR. Now, this is a contract where the payoff, whereas Eurodollar futures provides a payoff in advance, because in advance of the period that it applies to, because the rate at the beginning of the period. For SOFR, of course, you've got to wait till the end of the period before there's a payoff, and so the 3-month SOFR futures contract is designed to be as similar as possible to the Eurodollar futures contract, except for the timing of the payoff, because the payoff has got to be, as I say, in arrears for the period rather than in advance. But you can see that the open interest for the SOFR contracts is much less than the open interest for the Eurodollar futures contracts. So even though, the writing is on the wall in terms of, LIBOR being phased out, the SOFR futures, they're traded reasonably actively, but nothing like as actively as Eurodollar futures, and that applies, even more so to the options, as you can see from these 2 tables. Now, you could say, okay, but the contracts that trade are probably, these are US dollar, Eurodollar futures contracts, and we know, I've just said that US dollar LIBOR is not going to disappear until the middle of 2023. So probably most of these contracts expire before the middle of 2023. So I looked at that, and actually it's people seem to be pretty comfortable trading contracts on LIBOR when the contract matures after the middle of 2023. So you can see that the contracts traded on the day I was looking at, which was June the 14th, the contracts traded which mature before the middle of 2023. We had, about 1,386,000 contracts traded for Eurodollar futures, but actually we had 868,000 contracts traded which matured after June 2023. So that's a contract which trades on a rate that will no longer exist, assuming everything goes according to plan after the middle of 2023. So what's going to happen? Well, of course, CME Group has said we'll use the Fallback Protocol. So basically, they're going to convert the Eurodollar futures in the lower table there to SOFR futures, essentially, and use the spread that I've talked about. The median of the previous 5 years. But you can see that. So if you trade a Eurodollar futures contract that matures after the middle of 2023, or if essentially you're trading a SOFR futures contract, because it's the SOFR, it's the SOFR rate that will apply with this, this predetermined spread. Well, people just don't seem to be that concerned about this. Right now, if you look at the ratio of Eurodollar futures to SOFR futures for the contracts that mature before the end of 2023, there's about 20 times as many Eurodollar futures contracts trading as SOFR futures contracts, and it's about over 100 times as many post June 2023. Both sort of contracts, incidentally, have maturities that extend 10 years into the future, although the really long maturity contracts have very little liquidity. So this is interesting that people have not really moved away from Eurodollar futures yet, and it'll be interesting to keep track of that and see what happens. So the key questions, I think, for derivative markets, and this is my last slide, the key questions are, what will be the most liquid interest rate swaps, caps, floors, FRAs? I mean, as far as the over-the-counter market is concerned, interest rate contracts have been the most important contracts. As I said earlier, about 70% of the over-the-counter derivative contracts are in fact interest rate swaps, the most typical one being the exchange of Libor for fixed. And what's going to be the new one? What's going to be the new really popular over-the-counter interest rate contract? And this is, we can be talking about interest rate swaps, where we're trading some floating rate for fixed. It could be caps, it could be floors, it could be FRAs, and so on. So, to say, when the dust settles, when people finally realize that, Libor has disappeared or will disappear soon, what will be the new over-the-counter contract that replaces these really, really popular interest rate contracts that have been the bedrock of the over-the-counter market? And we have the same sort of question as I just mentioned in the exchange traded market, because the most popular exchange traded futures contracts have been contracts that pay off an amount dependent on Libor. And so, will the SOFR contracts become more liquid as time goes by, or will it, be BSB or Ameribor contracts that take over? So there's a few unanswered questions as far as derivative markets is concerned. If we come back to talk about this, shall we say in 3 or 4 years' time, I think we'll probably know what the answers to these questions are.